In today's video, we are going to talk about how to recognize revenue from contracts with customers. There's a lot to cover in IFRS 15, so this video will explain the basic concepts. First, I'm going to briefly discuss the background of IFRS 15. Then I'm going to talk you through the 5-step recognition model, along with some flowcharts and a working example. I'm going to leave timestamps in the description box below, so feel free to skip to any section you like. The previous revenue standards weren't very clear, so different entities had different ways of recognizing revenue, and it led to a lot of inconsistencies. To solve this issue, IFRS 15 was established, and its objective is to provide a single model for revenue recognition. So it now provides a robust framework for addressing revenue recognition issues. It improves comparability of revenue across entities and industries. It simplifies preparation of financial statements by reducing the amount of guidance that entities have to refer to. And it also requires additional disclosures to help users of financial statements to understand the revenue that is recognized, the nature, the timing, uncertainties. Now let's talk about the scope. IFRS 15 applies to all contracts with customers except for lease contracts, contracts within the scope of IFRS 17 insurance contracts, and items within the scope of the following standards. If a contract falls within the scope of IFRS 15 and also another standard, first, use the measurement requirements from the other standards, then apply the IFRS 15 standard. However, if the other standard doesn't give any guidance on how to separate or initially measure the contract at all, then simply apply the IFRS 15. Alright, enough on the background of the standard. Let's talk about the 5-step recognition approach. Step 1 is to identify the contracts with the customer. Step 2, identify the performance obligations in the contract. Step 3, determine the transaction price of the contract. Step 4, allocate the transaction price to each performance obligation. And lastly, recognize revenue when or as each performance obligation is satisfied. Okay, now let's have a look at each one in a bit more depth. Step 1 is to identify the contract with the customer. The standard defines a customer as a party that has contracted with an entity to obtain goods or services. There's an output of ordinary activities in exchange for consideration. So for example, a sneaker store. The output would be sneakers, and this would be exchanged with cash. And to identify a contract, we have 5 criteria we have to check. Have both parties approved the contract? Is there a transfer of goods or services? Are there payment terms? Is there a commercial substance, meaning will it affect the business and have an effect on future cash flows? And lastly, is it probable that the entity will collect the consideration? Meaning, is it something that's going to be paid in exchange for the goods or services? If the contract has all of those attributes, it needs to apply IFRS 15. However, what if there is a change in the contract? It might be a change in the scope or the price or both. For instance, if you have a contract with a business to supply 2 boxes of printer paper every month for a year, and each box costs $20. But halfway through the year, they want 3 boxes delivered instead. So now every month you're supplying 3 boxes instead of 2. So the scope is modified. And you're receiving $60 per month instead of $40. So the price of the contract also changed. In this case, you have to account for a separate contract. However, if only the scope changes or only the price changes, then it's not a separate contract, and we'll have to determine whether it's distinct, not distinct, or a combination of both. So what classifies as being distinct? According to the standard, it's considered distinct if the customer can benefit from the good or service either on its own or together with other resources, something that can be sold separately like furniture or equipment, and it's separately identifiable from other promises in the contract. Is it distinct in the context of a contract? For example, if a construction company agrees to build a house, the materials can be sold separately and would meet the first criteria, but it would not be distinct in the context of the contract because the output of the contract is a house. So you're integrating the materials, the service of building the house to deliver that output, and the materials can't be separated from that. So if the contract modification is distinct, we have to replace the existing contract and changes to the revenue are adjusted prospectively, meaning we adjust for the future. And if the modification is not distinct, then we have to treat it as part of the original contract and adjust revenue for both the future and the revenue that's already been recognized to date, meaning it's adjusted retrospectively. Lastly, if there are a few changes in the contract, and some are distinct and some aren't, simply apply the distinct method for goods and services that are distinct, and the not distinct method for those that are not. So now let's run through an example together. On 1st January 2019, a customer engages Construction Co. to provide construction services to build a house for $500,000. The estimated cost is $300,000. On 1st of January 2020, Construction Co. and the customer agrees to modify the contract to rearrange the layout of the kitchen for an additional $100,000. Estimated cost is $50,000. Construction Co. has been recognizing revenue on a stage of completion basis, and as at 1st of January 2020, 50% of the original contract value has been completed. So how should this contract modification be accounted for? Firstly, this wouldn't be a separate contract because although there is a price increase, the scope hasn't changed. The output of the contract is still the house. So now that we've established that, is the contract modification distinct? And the answer is no. It's not distinct because it's not separately identifiable. It's part of building the house. So in this case, we treat it as part of the original contract and adjust revenue retrospectively, both in the past and the future. So the cost incurred to date is $150,000 because 50% of the original contract has already been completed, and the cost of the house is $300,000. The updated total expected cost is now increased to $350,000, which is from $300,000 of the original contract plus $50,000 for the new kitchen. Now we have to calculate the new percentage of completion by using the new total expected cost since it's no longer 50%. So we divide the $150,000 that they already incurred by the new total cost of $350,000, and the new percentage is now 42.86%. Using the new percentage, the new revenue recognized is $257,143, which comes from multiplying the percentage by the total transaction price of $600,000. $500,000 for building the house plus the additional $100,000. Lastly, we have to work out the revenue adjustment. Since the new revenue recognized is $257,143, but we have only recognized $250,000 to date, we need to adjust this and credit the difference of $7,143. If this is a little confusing, run through the example a few more times or simply leave a comment about which part you're confused about and I'll get back to you and try to help you out. Once a contract has been determined, you must identify the performance obligations in the contract. Usually one performance obligation is pretty easy to determine. But what if there is more than one performance obligation? A promise constitutes as a performance obligation if it's for the transfer of either a good or a service that is distinct, or a series of distinct goods or services that are substantially the same. For example, a repetitive service contract, cleaning contracts, contracts to deliver electricity or gas. In step 3, we have to determine the total transaction price, which is the amount of consideration that you expect to receive in exchange for transferring goods or services. And this excludes amounts collected on behalf of third parties, such as tax. Sometimes the transaction price is very straightforward and a fixed price is written in the contract. However, sometimes it's not so straightforward and you have to consider the variable consideration, including any constraining estimates of that consideration. Variable considerations include items such as refunds, discounts, rebates, etc. You also have to consider the existence of a financing component, non-cash consideration, which is measured at fair value, and consideration payable to a customer. For instance, as an incentive to encourage customers to purchase a good or service, you might provide vouchers or a free product or service. After the transaction price is determined, you have to allocate the transaction price to each performance obligation. The allocation process is pretty simple when the entire transaction price is allocated to one performance obligation. But what if there is multiple performance obligations? Then you have to portion the transaction price to each performance obligation based on the standalone selling price of the distinct good or service. This is how much the good or service would be if it was individually sold to a customer. I'll quickly run through the last step and we'll go through an example together. Step 5 is to recognize revenue when each performance obligation is satisfied, meaning when the good or service is transferred to the customer. So it is transferred once the customer has obtained control, and revenue may be recognized over time or at a specific point in time. If you're supplying printer paper every month, you'll recognize the revenue over time, meaning it's recognized monthly once it has transferred to the customer. Alright, now let's have a look at an example. ABC Limited entered into a contract with Thomas to provide a custom-made bed frame. The contract price is $3,000 and it includes delivery and installation. And ABC Limited does not provide installation services separately. The standalone market price for installation is $200 and for delivery it's $200 as well. And for a similar custom-made bed frame, the standalone price is $2,800. Now let's go through each step. Step 1. Identify the contract with the customer. This is pretty straightforward. The customer is Thomas and we have an agreement between two parties. So that is satisfied. Step 2. Identify the performance obligations in the contract. So how many performance obligations do we have? In this case, we have 2. The first one comes from a delivery service of the bed frame because it's distinct. It's a service that can be provided separately and it's separately identifiable from other promises in the contract because ABC Limited can provide the bed frame without the delivery service. The second performance obligation is the bed frame and installation. Since the case facts say that ABC Limited does not provide installation services separately, it doesn't meet the criteria of a distinct service. So providing the bed frame is interrelated with the installation service, and it's seen as one performance obligation. Step 3. Determine the transaction price. This is pretty simple. So the transaction price is a fixed price of $3,000. And step 4, allocate the transaction price to the performance obligation. So this part requires a little bit of calculations. As I mentioned earlier, if there are more than one performance obligation, you have to portion the transaction price to each obligation based on the standalone selling prices. So the sum of the standalone prices is $3,200, which is from the delivery price of $200, installation price of $200, and a similar bed frame would cost $2,800. The delivery is worth $200 of the $3,200, which is 6.25%. And the installation and the bed frame is worth $3,000 of the total $3,200, which will give us a percentage of 93.75%. Now we allocate the percentages to the total transaction price, which gives us our proportion. So the allocation of the transaction price to the delivery service is 6.25% times $3,000. Which is $187.50. And the bed frame and installation is $2,812.50. Step 5. Recognize revenue when each performance obligation is satisfied. In this case, ABC Limited can recognize the revenue once the custom bed frame is delivered to Thomas, because that's when it's transferred out. So that was a summary of the 5-step recognition model. I hope you now understand the basic concepts of IFRS 15, and feel free to leave me a comment if you're unsure of anything we discussed in this video.